India looks strong, but the money says otherwise. For more than 20 years, one of the most experienced emerging market investors has stayed bullish on India. He says it clearly. I've been an India bull for probably 20 or 25 years. Yet right now, India is underperforming, foreign funds are exiting, the currency is weak, and even believers admit the market didn't have the growth that was expected and didn't have the capital investment that was expected. That's the contradiction. Massive long-term optimism colliding with short-term disappointment. And if you have money in markets, this isn't abstract. This determines where capital flows next, which countries win the next decade, and whether patience still pays. The market is expensive. The start to the year has been not very good, and yet the conviction hasn't broken, not even close, because the argument being made isn't about this quarter. It's about something much bigger that most people are missing. The question isn't whether India is struggling now. The real question is why so many seasoned investors are willing to wait anyway, and what they think happens next. What looks like hesitation is actually positioning. Here's what we know, and only what's supported by the content. India underperformed expectations last year. Growth came in lower than forecast. Capital investment didn't arrive at the scale investors were counting on. One investor put it bluntly, India was just kind of deflated. The year started weak as well. India hasn't gotten off to a very good start so far. Foreign funds have been pulling back, driven largely by currency weakness. Strategists, by admission, are not enthusiastic right now, but notice what this framing leaves out. No one is saying the long-term story is broken. In fact, the opposite keeps coming up. Government support remains, capital expenditure is starting to pick up, and critically, there's an expectation that fiscal stimulus could change the trajectory quickly. The core idea being floated isn't that India is failing, it's that India is early. That matters because markets don't price decades, they price sentiment. So here's the reframing question. Investors are quietly asking, when optimism fades but fundamentals remain intact, is that risk or is that opportunity? Because historically there have only been maybe 4 different times when sentiment on India turned this negative. And every time before, the next few years told a very different story. Here's the first hard claim, and it's not subtle. India is still inefficient. And that's exactly why some investors think it can outperform. That sounds counterintuitive, so let's anchor it in the content. One investor says flatly that India remains a market where stock pickers can outperform. He immediately contrasts it with the United States, calling the U.S. an efficient market where that edge largely disappears. The implication is clear. In India, pricing gaps still exist. Information isn't fully absorbed. Value doesn't get arbitraged away instantly. And because of that, selective investors believe they can still find mispriced opportunities. That's not a vague theory. It's why he says he wouldn't be really underweight India in an emerging markets portfolio, and why personally he says I am overweight India. But here's the detail that changes how you should hear this. India is expensive. He admits that outright. It has always been expensive. So this isn't a value bet in the traditional sense. It's a structure bet, an inefficient market plus long-term growth plus selective entry points. Now notice what's missing from the criticism. No one says the opportunity is gone. No one says the system has matured past returns. The hesitation is about timing, not direction. And that's where this story starts to tighten. This is where the pressure quietly builds. Despite the weak start, the expectation isn't stagnation. It's acceleration. The content points to capital expenditure beginning to rise and the possibility of fiscal stimulus changing the pace. The investor notes that if this happens, India will do better. That sounds mild, but the comparison that follows isn't. He contrasts India with China. China, he says, has already done the hard part. China has done such a phenomenal job on its economic growth. India hasn't. And that's the point. because China has already realized much of its expansion. India has a lot of catching up to do. And over the next 5 to 10 years, he believes India has the possibility for greater growth than China, precisely because that growth hasn't happened yet. This is the normalization moment, a slow year, a weak currency, bureaucratic drag. None of that is framed as abnormal. It's framed as part of a longer pattern where structural growth pushes through friction. And here's the unsettling part. If underperformance becomes normal, investors stop paying attention. That's often when capital quietly starts building positions again. Not loudly, not at the top, but before momentum becomes obvious. The second proof hit goes deeper, and it's less comfortable. On one hand, investors talk about caution. On the other, their actions say something else. The same voice warning about bureaucracy, currency pressure, and slow starts is also pointing to opportunity across equities, fixed income, and private debt. He says there are a lot of opportunities even in fixed income in India, and calls out private debt specifically, noting there's a huge spread there. That's not defensive language, that's positioning language. Then comes the contradiction that changes how you see the whole debate. Foreign funds are exiting, but not because the story collapsed. He says it directly. That's a currency issue, not a growth collapse, not a political shock, a currency move. At the same time, the government is described as structurally supportive, even if hesitant. Fiscal stimulus hasn't fully arrived yet, but the suggestion is that it probably needs to. And here's the line that flips the frame. India gets in its own way, yet still delivers 6 to 7% growth. Think about that. With bureaucracy slowing things down in many ways, growth is still that strong. The contradiction between friction and output is the signal. If the friction eases even slightly, the outcome changes fast. Now the story compresses, and the pace matters. Multiple forces start stacking at once. Consumer spending remains massive, driven by a population of 3 billion people, with most under the age of 30. Urbanization is increasing. At the same time, employment in electronics manufacturing is expected to rise very rapidly. Then comes the bolder claim: India is positioning itself to become a major producer of semiconductors. The speaker admits it sounds far-fetched at this stage, but insists the capability exists and the need is unavoidable. India must catch up to China and the US. Meanwhile, manufacturing is already shifting. Consumer electronics assembly is expanding. Companies are moving upstream into more sophisticated components. And while many semiconductor startups aren't publicly listed yet, exposure is already forming through software, where a lot of the chip software is already being produced and done in India. These aren't isolated bets, they're linked moves happening under time pressure while capital is still cautious and sentiment remains muted. That's the tension. Growth channels are opening before the crowd believes in them. So pause here and ask the uncomfortable question: what happens if this continues? At some point, this stops being a portfolio story and starts becoming personal. Because this isn't just about returns on a screen. It's about how these shifts show up in real life. Consumer spending isn't an abstract metric when you're talking about over 1 billion people, most of them young, moving into cities and spending more on housing, electronics, services, and everyday goods. 6 to 7% growth isn't a headline when it translates into more jobs in manufacturing software and assembly lines that didn't exist before. When electronics manufacturing expands, it means employment rising very rapidly. When production moves from simple assembly to more sophisticated components, it means higher wages and more stable work. And when manufacturing shifts from China to India, that affects supply chains, prices, and availability globally, including for you as a consumer. But here's the reset moment. This progress is uneven. Bureaucracy still slows things down. Currency weakness still scares off foreign capital. The benefits don't arrive all at once. They arrive in pockets, then spread. That lived inconsistency is why the story feels confusing on the surface. If this tension between promise and frustration feels familiar, say so in the comments, because that gap is where the next phase usually forms. Here's the part mainstream coverage usually misses, because it's quieter and harder to explain. What allows this situation to exist is leverage inside the system. India is open, capital moves, states compete with each other. There's an English-speaking, highly educated elite that can absorb technology from anywhere in the world. The speaker points out that if you travel globally, you see Indians training in every direction and doing advanced tech work everywhere. That matters because it lowers friction when new industries arrive. At the same time, the government is described as hesitant but not hostile. Fiscal stimulus hasn't been aggressive, but structural support remains. That creates a strange equilibrium. Growth continues, but not explosively. Markets stay inefficient, capital hesitates, and that hesitation is the mechanism. It prevents overheating while capacity quietly builds. Add to that India's openness to trade. Despite noise around U.S. relations, the claim is that trade with the U.S. and China will do very well. Even political tension is framed as bargaining, not rupture. The unsettling insight is this: systems don't need perfection to grow. They need resilience, absorption capacity, and time. India has all three. Now we're at the fork in the road, and neither path is clean. One path is delay. Currency pressure persists. Bureaucracy continues to slow execution. Fiscal stimulus stays cautious. Capital waits. In that scenario, India underperforms longer than expected, and frustration deepens. The optimism stays verbal, not financial, but there's another path forming at the same time. Capital expenditure accelerates, consumer demand keeps compounding, manufacturing continues shifting from China to India, software and electronics move upstream, and suddenly the same investors who were hesitant start increasing exposure, not because sentiment changed overnight, but because momentum became undeniable. The content makes one thing clear: the next move isn't theoretical. It's already starting. India is now doing very well, the market is improving, and the view remains long-term. Returns of 12 to 15% are being discussed, but only over time. Some say 3 to 5 years. Others are positioning now selectively, unevenly, quietly. That's what makes this phase dangerous and interesting. By the time certainty arrives, the positioning window may already be gone. Here's the insight that ties the entire story together. India isn't being priced for what it is. It's being priced for what it hasn't fixed yet. Bureaucracy, currency volatility, slow execution. And yet, even with all of that, the economy still grows at 6 to 7%, consumer demand keeps expanding, and manufacturing keeps moving in. That's the paradox. The friction everyone complains about is also what delays consensus and preserves opportunity. When investors say India gets in its own way, they're describing the same mechanism that keeps it inefficient, underowned, and misjudged at key moments. This isn't a story about perfection. It's a story about scale, time, and absorption. Over 1 billion people, a young population, technology flowing in, capital slowly following. The market doesn't flip all at once, it creeps, then accelerates, and the most important moves usually happen before the narrative catches up. This is one of those moments where the signal is quiet, but the implications are large. If you want to stay ahead of where this story goes next, follow and subscribe for the next layer of this analysis.